And on the 9th of May 2026, the Enforcement Directorate walked into a Punjab Cabinet Minister's office and arrested him under Section 19 of the PMLA. Sanjeev Arora, Industries and Power Portfolio, promoter of Hampton Sky Realty Limited, a listed entity. Books audited, every rupee routed through an authorized dealer bank. Bank realization certificates uploaded on the DGFT EBRC portal. And yet, handcuffs. Here is what every managing director in Gurgaon, South Delhi and Mumbai needs to understand in the next 90 seconds. On the 17th of April 2026, ED officers searched Hampton Sky Realty's premises. 2 days later, 19th of April, provisional attachment orders. Section 37 subsection 3 of FEMA, read with Section 132 subsection 9B of the Income Tax Act. The number on that attachment was 157 crores 12 lakhs, of which 102 crores 50 lakhs related to overseas export transactions routed through two UAE entities, Port Bell Telecom, FZCO, Dragon Global, FZCO. Now stop right there. The company's own disclosure to BSC, filed under Regulation 30 of the LODR regulations, stated every single export was verified at multiple statutory stages. BRCs issued, EBRC updated, no loss to the exchequer. The Delhi High Court confirmed in Arun Suri, February 2026, that even this level of compliance does not insulate personal assets from attachment. 20 days later, the promoter was in ED custody. And the attachment did not stop at the company. It extended to a family member, Kavya Arora, whose holdings were folded into the perimeter under the equivalent value doctrine of Section 2, subsection 1, Clause U of the PMLA. The question every promoter watching this needs to answer: if full FEMA compliance did not save a serving cabinet minister, what exactly does it save you from? We'll give you the precise answer in 3 minutes. It is not what your CA has told you. But the FEMA attachment is only half the trap. The real liability is not in FEMA at all. It sits in a schedule that most boards have never read and that your AD bank cannot see. Every statutory audit in India checks against FEMA. Not one of them checks against this. Let me explain why. FEMA, the Foreign Exchange Management Act, was Parliament's promise to Indian business. Repeal FERA, decriminalize foreign exchange contraventions, civil penalties under Section 13, compounding under Section 15, adjudication by departmental officers, no arrest for contravention. That was the bargain in 1999. Now ask yourself this. If FEMA is civil, how does an alleged FEMA violation land you in ED custody under PMLA Section 19? The answer is, it does not. Not directly. Open the schedule to the PMLA, Parts A, B and C. Cheating under what was Section 420 of the IPC, now Section 318 of the Bharatiya Nyaya Sanhita. Forgery, Sections 336 to 339 BNS. Criminal conspiracy, Section 61 BNS. Customs Act offences relating to bogus exports under Sections 132 and 135. Companies Act fraud under Section 447. FEMA is not in the schedule. It has never been. So the ED does not prosecute FEMA contravention under PMLA. It prosecutes the underlying scheduled offence and treats the foreign remittance as the laundering of the proceeds of that offence. That is the bridge. That is the trap. And here is why your CA cannot see it. Your authorized dealer bank verifies form. Documents present? Tick. Master direction compliance? Tick. Shipping bills uploaded? Tick. ERC issued? Tick. The AD bank does not and cannot investigate whether the invoices themselves are fabricated, whether the counterparty in Dubai is a shell entity, whether the goods on the shipping bill physically moved. The ED in the Hampton Sky matter has alleged exactly this. Fake purchase invoices, round-tripping through UAE, fake GST input tax credit obtained from what they describe as non-existent firms in Delhi. These are allegations, not judicially tested. But they are the precise category of allegations that turn a clean FEMA file into a Section 3 predicate offence under the PMLA. Look at your last export file. Does it contain anything beyond the AD bank's tick box confirmation? If not, the ED will build the substance case and you will not have a counter narrative. And this is where most promoters make their first catastrophic error. The cascade then runs on rails. The ED registers an Enforcement Case Information Report, an ECIR. The Supreme Court held in Vijay Madan Lal Chaudhary 2022 that the ECIR is an internal document. You are not entitled to a copy. You will not see it. Then comes Section 50 PMLA, the summons trap. You are called to record your statement on oath. You are not yet formally accused, so Article 20, subsection 3 of the Constitution does not attach. Your statement is admissible against you. That is the ratio of Vijay Madan Lal. And the Supreme Court clarified in Prem Prakash 2024 that statements recorded post-arrest have limited admissibility. But by then, the damage to your bail application is already done. Then provisional attachment under Section 5, a fresh 180-day clock, confirmed by an adjudicating authority that sits only in New Delhi. Your Bengaluru factory, your Gurgaon office, your Mumbai flat, all contested in Delhi. And then, when the ED is ready, Section 19, arrest. That is the architecture. FEMA compliance is the bait, the schedule is the hook. Now here is what every CA and every Big Four tax partner is telling promoters in Aerocity boardrooms this quarter. I have seen 4 opinion letters in the last 60 days that say in substance the following. If it went through the AD bank, you are protected. If the auditor signed off, you are protected. If the EBRC was generated, you are protected. All 3 statements are dangerously incomplete. The Bombay High Court in Shyam Radhakrishna Malpani, the Bhujbal Group matter, discharged a statutory auditor from PMLA proceedings. Paragraph 29. The court held that an auditor's role is confined to the documents made available to him. He is not expected to investigate underlying genuineness. Read that holding carefully. It protects the auditor. It does not protect the promoter. The promoter's presumptive knowledge of the underlying transactions is treated as fundamentally different. Section 3 of the PMLA catches any person directly or indirectly involved in any process or activity connected with proceeds of crime. A promoter does not get to hide behind his own auditor's clean opinion. And the corporate veil, the doctrine your structuring council sold you in 2019, has been quietly demolished. Delhi High Court, 16th of February 2026. Arun Suri versus Directorate of Enforcement. The plea of the property being ancestral does not ipso facto grant immunity from attachment under the PMLA. Your father's house, purchased in 1991, well before any alleged offence, is not immune. Section 2, subsection 1, clause U permits attachment of property of equivalent value where direct proceeds cannot be traced. This is why Kavya Arora's holdings were folded into the Hampton Sky perimeter. This is why the ED attached 40 properties of Anil Ambani valued at over 3,000 crores, including the Pali Hill residence in Mumbai, in a matter still under investigation. And if someone has told you that M3M India got the Supreme Court to swap attached land for commercial units, read paragraph 7 of that order. The court expressly said, not a precedent. Substitution requires ED consent. It is a negotiating tool, not a right. The attachment perimeter is not the company. It is the family estate. If the ED cannot trace the direct proceeds of the alleged offence, they will attach your Chhattarpur farmhouse, your wife's demat account, and your son's flat in Greater Kailash up to the value of the alleged proceeds. That is the law after Arun Suri. And the Section 45 bail test, the reverse burden upheld in Vijay Madan Lal, requires you to prove probable innocence at the bail stage, not flight risk, not witness tampering. Innocence before trial with no access to the ECIR. That is the trap your CA cannot see, because your CA is looking at compliance. The ED is looking at substance. Last year, the ED issued 461 provisional attachment orders. 34 convictions followed. The attachment is the punishment. The trial is the afterthought. So if you are sitting in a board meeting next Monday, here is the briefing. First, your audit file is the floor, not the ceiling. The AD bank confirmation, the auditor's clean opinion, the EBRC, necessary, not sufficient. The strategic move is to build a parallel substance file. Beneficial ownership documentation for every material counterparty. Independent KYC, that is baseline. Physical evidence of goods movement, third-party inspection certificates, site visit photographs, contemporaneous logistics correspondence. Not for compliance, for Section 45 bail. Second, assume your family is in the perimeter. The Arun Suri ruling closes the ancestral property defense. The structural move, every person holding 10% or more in your group entities must have independently documented source of funds, inheritance papers, capital contribution records, bank trails, maintained in multiple jurisdictions if you operate internationally. Third, pre-position your governance protocol before any enforcement step. LODR Regulation 30 triggers a 24-hour disclosure obligation on the arrest of a director or promoter. Section 164 of the Companies Act does not automatically disqualify on arrest, but your lender's material adverse change clause does. Your private equity investor's criminal event put right does. Your D&O insurance needs defense cost cover for regulatory investigations. Most standard Indian policies exclude criminal acts but provide defense costs pending adjudication. Check the wording. Today, not after the search. None of this prevents an investigation. All of it positions you to defend one. Our team has put together a document we use internally when we brief promoters in this position. We call it the 2-track checklist. It covers both tracks, FEMA civil, PMLA criminal, and includes the documentation matrix we use to build a substance file capable of surviving an ECIR. The link is in the description. Download it before your next board meeting. Hand it to your CFO, your general counsel, and your statutory auditor in the same room. Make them read it together. The gap between what each of them assumes the others are checking is precisely where ED enforcement enters. If you found this video informative, please click the like button, and for more such insightful legal updates, subscribe to the channel. And thank you so much for watching. I will see you in the next one.